Well, it is no surprise that when it comes to the basic tenets of technical analysis, order blocks have become a crucial part of the smart money concept, especially when it comes to entries. And for that reason, in today's video, I'm going to share with you exactly what you need to know about order blocks and the theory of institutions. So in this module, I will cover what order blocks are, which is basically an introduction to order blocks, the theory of institutions, which explains how and why the institutions need to form these order blocks, how to map order blocks and examples, entry and stop loss placement on order blocks, and then finally you will be given a take home to make sure you understand the concept explained to you in this module. An order block is simply the last candle before a major move, and in that case, a bullish order block will be delineated as the last down candle before the major up move, and the same concept will apply to a bearish order block, which is the last up candle before a down move. A practical example on the charts will look like this. So for a bullish example, you can see we have this impulse to the upside followed by a retracement, and then another impulse that actually caused this break of structure to the left, indicating the willingness of price to continue higher. And as you can see, this happened to be the last down candle before the up move that caused this break of structure to indicate the willingness of price to continue higher on this time frame that I'm looking at. Okay, so on the 2-hour time frame, this last candle before the up move will actually be my order block, so you can see. And then when price causes this break of structure and then continues higher, and more often times than not, we expect price to come back into the order block so that the institutions can mitigate any open orders they have before price continues in its original direction. And as you can see, we have price come back into the order block before making another impulsive move to the upside that caused this break of structure to the left. So you would identify this as your push, exhaustion, and another push phase. Okay, so ideally this is the last down candle before this up move, so you would want to mark that as your order block. And then you can see that in the future price actually came back into that area before continuing to the upside, and then we have another push, exhaustion, and another push to the upside that has caused this break of structure. Now these breaks of structure actually indicate the willingness of price to continue to the upside. Okay, and then we can clearly identify this as the last down candle before this up move, and as you can see that later on in the future price came back to that order block, and then we have a reaction. Now this isn't a sizable reaction compared to this move here, but that is because after this impulse, exhaustion, and another impulse, we have a break of structure. So order flow is no longer bullish but now bearish, and sometimes in bearish conditions, bullish order blocks are not respected. You'd often find out that they're violated. Now this is just to explain to you what order blocks are and lay the foundations on how to trade order blocks. There's a whole section in this module that is dedicated to showing you how to correctly map these order blocks, which we'll get to in a minute. Now I love to view order blocks as a receipt for all the transactions carried out by smart money. The last up or down candle is ideally where smart money have performed all their transactions, and understanding how smart money traps traders can actually take trading for us to the next level, and that brings us to the next content in this module. So when it comes to the dynamics of order flow, the institutions basically have 3 objectives, which without it's almost impossible for them to make money. Now I have mentioned before that there isn't an unlimited amount of liquidity in the market. The banks and institutions can't just buy and sell simply because they feel like buying. They need sellers to buy from and buyers to sell to. Now this simply means your money just sitting in your trading account without you risking any of it is useless to them, because they need you to put some money so that they can take that away from you. Okay, in the induction phase they need to give you some action to make you hit that buy or sell button, and They do that by actually printing these engulfing candlesticks that you can see here, okay? Because you were taught as retail traders that whenever you see an engulfing pattern, that is to signal an injection of momentum. But these are all created by smart money to give you some action so that you can put your money in the markets, okay? The second objective, which is the trap phase, is also important to them because without trapping you, smart money cannot make any money. Okay, so when they induce you to take a position, they have to trap you to get you on the wrong side of the position, because when smart money is buying, they need you to sell to them, and when they're selling, they need you to buy from them. Now, when you tie all this up together, it leads us to why and how smart money form order blocks, which I will explain to you on the chart. So just like I explained before, in the induction phase, they give you some action in order for you to hit the buy or sell button, okay? So as you can see that we had price trending beautifully to the upside, and then you can see a breach of this trend line that actually signals a momentum shift, okay? The trend has now changed from bullish to bearish, okay? So it is now time to sell. Now, what you can actually see is that even when price was trending beautifully to the upside, they gave you this impulse and this slight correction to the side, and then you can actually see that this is a strong candle that engulfs the candle prior to this one. Now, this is a bullish engulfing pattern, which is actually taught to the retail traders to actually see this as a bullish market, okay? And you can see that this is an induction by smart money to make you buy. And notice how immediately after this bullish candle, we have an inside bar, okay? So smart money is actually creating a trend, because this is a 2-hour time frame, and if I should scale this to a lower time frame, you would actually see that this might look like a trend, okay? So if you haven't watched the video where I talked about market structure from an institutional perspective, I think when you watch that video, you would actually understand that this is just a retracement in an impulse leg, okay? So smart money have to induce you, okay? Because in order for them to get away with their size, they use a hedging protocol that allows them to sell into their position and buy into their position. Now, I would explain all of that in a second, okay? I just want you to understand the induction phase. So this bullish candle is to induce you to buy, and when you buy during this induction phase, smart money is actually placing small blocks of buy orders, okay? They're actually putting some buy positions in order for them to induce you to buy. Now, when you fall for the trap and actually buy, they actually get you on the wrong side of the position by using a hedging protocols, which is basically them selling into their buy positions, okay? So for example, they actually, let's say, place like 50 billion sell orders, and they get some retail traders to buy, and let's say the retail traders and some other larger institutions are also buying when they see this. So smart money has 50 billion buy orders here, and then let's say the average retail traders have about 20 billion buy orders too, and the institutions also have about 50 billion buy orders. Now that is simply enough sell orders to be filled for smart money. So smart money simply sell into those orders by using a hedging protocol that allows them to sell into their position. Now when they do this, you can see that after this impulse, it is followed by another impulsive move down. They have successfully induced you and then successfully trapped you on the wrong side of the position. And as you can see that we have this impulse, this retracement, and another impulse. So this happens to be the last up candle before the down move, okay? So this is basically where smart money have carried out all her transactions, and more often times than not, when you see this extraordinary move out of nowhere, smart money will actually come back to mitigate these losses, because they have billions of positions that are in profits, okay? Remember, they bought here in order for them to sell. So when they bought, they still have open buy positions that are in drawdown, and their sell positions are in a lot of profit. So what they do is they close those sell positions, that are in profit and then bring price back up in order for them to close this open buy position in either a little profit or a small loss. Now, smart money have whatever it takes to play this game as long as it takes. Now, the reason smart money does this is because unlike the retail traders who are trading through a broker, that is, for retail traders, the broker is connected to the liquidity pool and we are connected to the broker, so we're basically placing our orders through them. And unlike us who have to pay for commission and spread and swap, smart money doesn't actually pay for all those things, because when they buy, they physically own the contract. Okay, so they don't actually use stop losses, so they never lose just the way you do. Okay, so when price hits your stop loss, theoretically you actually lose money. The broker actually takes some money out of your account, but smart money actually owns this contract, and the only way they can lose is when they sell their contracts at a losing price. Now, an example of that would be when you buy Bitcoin and it's in your wallet. Remember, you don't have to pay spread or swap or anything, and when you buy Bitcoin at, let's say, 50k for an example, and then Bitcoin dips to about 40k, you have not really lost your money, you've only lost the value of your Bitcoin, but it's still in your wallet. Okay, unless you take that Bitcoin and sell it to another person, you haven't lost any money. And that's the same with smart money. Okay, so when they still have these positions in drawdown, they aren't really losing yet until they physically sell those contracts to someone else. So they can hold this as long as they can in order for them to come back and close any positions here, because they've successfully induced you and trapped you. Okay, and also the last objective for smart money is to stop you out. Now, when you write about a trade, smart money will stop you out, because for them to make money, you have to be on the losing side. Now, an example of that would be you have this push, this exhaustion, and this push. It causes this break of structure. Now, if you zoom in closely and you go ahead and use the Fibonacci tool, there's loads and lots of traders who would actually see price come into the 50% or to 61.8 and be like, whoa, this is the golden zone. This is a nice opportunity for us to be selling. And the reason why those fib levels do not work is because there is a mitigation that has to be happen. Okay, so when they sell at 61.8, they place their stop loss above the level. They're actually right about the direction. The trend is down, but smart money will actually stop them out. Now, look how all this ties together. They induce you by printing engulfing candles. Okay, they trap you by creating a fake trend, and then they stop you out when you're right. So this is basically how smart money delivers price, and nothing in the markets happen randomly. Everything is discounted for on the price chart. So now we move on to the next content in this module, where I will talk about how to map these order blocks correctly. So when it comes to mapping order blocks, you don't want to make things any complicated than it is already. Okay, so remember, an order block is the last up candle before a down move. That's for a bearish order block, and a bullish order block is the last down move before an up move. Now, the first thing you want to do when mapping order blocks is you want to identify the trend. Okay, you want to identify the trend because in a bearish market, bullish order blocks will not be respected. Okay, I'll give you an example of that. Now, you can see that you have this push and you have this impulsive move, and this happens to be the last down candle before the up move. But you can see that when price came back into that, price did not even show any reaction. Okay, so that is the reason why in a bearish market you want to focus on bearish order blocks, and in a bullish market you want to focus on bullish order blocks. So the first thing you want to do when mapping order blocks is identifying the trend. We can clearly see that for this one we are in a bearish trend. Okay, like I said earlier, we were trending nicely to the upside, and we have a momentum shift, which is a break of this trend line to indicate that the sellers are now in control. So the next thing you want to identify after the trend is you want to identify this is a bullish example. You want to identify a push phase, okay, an exhaustion phase, and then another push phase that causes this break of structure to the left. Now, the reason why you want to see a break of structure to the left is because this is the indication that price is willing to continue higher. So remember, in an uptrend you want to see series of highs and series of higher lows. Okay, new highs and new higher lows. So you want to identify this push phase, an exhaustion, and another push phase. So the last candle that caused this break of structure would actually be your order block, and then you were expecting price to make a retracement so that smart money can mitigate any open orders they have, and then for price to continue in its original direction. Very simple stuff, nothing too complicated. Okay, so I'll go over it again. You want to identify the trend, you want to identify a push phase, an exhaustion phase, and then another push phase. Okay, so I'll show you that in a minute. I hope you guys can hear me clearly. I think I have catarrh, so my voice is kind of not at its loudest right now. So this is your push phase, this is your exhaustion phase, and another push phase that caused this break of structure. Okay, so you can see that this is the last up candle before the down move that caused this break of structure. So that is basically your order block, and you can see that price came back into the area. This is called your point of interest. Okay, now a point of interest, or a POI or PRZ, is simply a possible reversal zone or a point of interest. That is basically the whole area that where order block is sitting. Okay, so that is the area. In and around those areas are places you want to expect price to actually reverse. Okay, as you can see, this whole order block is our point of interest or our PRZ. Some traders call them AOIs, meaning area of interest, but they all mean the same thing. Okay, so as you can see, price came back nicely, and then we had a mitigation. So we have another impulse, exhaustion, and impulse, but this time price didn't come back. Okay, so we keep going. You can see impulse, retracement, and then another impulse. Now you can decide to say this is the last up candle before this move, and you can say this is the one, but this is a 2-hour time frame, and probably on the 4-hour time frame this would be a single 4-hour candle. So it's actually okay to say that this is your point of interest. Okay, because sometimes when you have these candlesticks cluttered like this, clustered, or when I say cluttered, whichever the case may be, you want to just take the whole area. Okay, so that's it. This is your order block or your order blocks, and then you have your break of structure, and then you see price comes to mitigate. Now here's something interesting that you might see. We've marked this order block and we know that price is coming to mitigate this. Now remember, in the market structure video I talked about also taking advantage of the smaller trends in this retracement, and as you can see that we have impulse, retracement, impulse, and you can take this to be your order block. Okay, and then you see price has come back to take this. Now this is a little bit counter trend, but you're trading this bearing it in mind that this is just a retracement of this larger impulse. Okay, so that's basically what you have in mind. Now as you can see, when price came into our area of interest, you have impulse, retracement, but price failed to make a new high, and now what do we have? A break of structure. Okay, so it's as simple as that. Very simple. You don't want to complicate things. And we can see impulse, retracement, impulse, and this is more like an impulse, a retracement, and an impulse, a retracement, but price failed to make a new low. So we have now transitioned from a bearish trend into a bullish trend, and then this is time for a bullish example. You have your impulse, retracement, impulse. Now you can see clearly here that this is your order block here. Okay, you have another impulse crossing the break of structure. This last down candle here, let me get this out of the way quickly. So you can see we have another order block here. Okay, so this would be more like impulse, retracement, impulse, and this is another impulse, a retracement, and another impulse that has broken this structure to the left. So bullish trend. Okay, and as you can see, last down candle before the up move, we have a mitigation there. Okay, very simple stuff, and this mitigation here has also created another order block. So you can clearly see that we have this last down candle before this whole move, and that is your order block. Now I will also make another video that basically talks about how to refine these order blocks. Okay, there's a way to actually refine these order blocks, because imagine this to be a monthly time frame. This would be your whole range, and I trust that no retail trader, or you can barely find any retail traders who take any entries on a monthly time frame. So if we can get this video to 1,000 likes, I would make another video on how to refine order blocks, and then a complete order block strategy video. that basically teaches you how to implement these order blocks as a strategy. Okay, very simple stuff. Okay, I'll just go over a few more examples. So we have this consolidation to the side, and we have this whole impulsive move that has broken this structure to the left. Okay, so breakout bullish. Now in this case you have 2 points of interest. Possibly you have this one, and you also have another point of interest. So in the video I said I will be releasing, I will talk about how to deal with multiple points of interest, and then also how to take entries on these how to deal with multiple points of interest basically, and how to refine order blocks. Yeah, so you have this, maybe you took some losses here or whatever be the case. Now you can also see that we have this impulse, a retracement, and here's your last up candle. Okay, so you can see that you almost had a mitigation on this candle. Impulse, retracement, impulse, and then you have another mitigation that would have happened here, okay, before price switched bullish. And there's a breaker structure indicating the willingness of price to continue higher, and then this whole area right here is your order block. So next we talk about entries and stop loss placement on these order blocks. So now that you actually understand how to map these order blocks and you know what order blocks are, let's talk about how to take entries on order blocks and where to place our stop losses and take profit. After you have identified your push, exhaustion, and a push phase, this whole area is your order block. Now when mapping order blocks, you basically want to take the high and the low of the candle. Okay, so this wick represents the highest point and this lower wick represents the lowest point. So you take this and this. So this basically here is your area of interest. Okay, I'll go ahead and mark that out. Area of interest, or POI. Personally, I love to call them area of interest. So this whole range is where you're expecting price to come into and mitigate before moving to the upside. But the question would actually be, since we have a range as large as this, where would price actually come to before we expect a mitigation? Now you can take entries possibly anywhere near the highs to the 50%. Now some traders prefer to take entries at the 50%, so you can use your Fibonacci tool to actually measure the 50% of the order block. Now the 50% doesn't really mean anything special, but it is basically regarded as the mean threshold. Okay, so this is just halfway through the candle, because on order blocks that are really strong order blocks, you don't want to see price trade below the 50%. You just want to see price come somewhere around the open and the highs of the candle, and not to cut too deep into the 50% of the candle. So that is where basically some traders take entries. But personally, like when I started trading order blocks, before I learned how to refine them, okay, I would basically use the high of the candle, few pips before the high of the candle, because you want to factor in the spreads. Okay, because when the spreads are too wide and you place your entry exactly at the open, you might not really get triggered in, because sometimes you're not basically going to be on the charts all day, so you can use a limit. Now when it comes to stop loss placement, your risk is as far as how big the order block is. So that is why you have to refine your order blocks, because they don't just give you a smaller stop loss placement, but smaller stop loss placement can guarantee a higher risk to reward. Now look, let me use this as an example. Now if you were to use the whole range of the order block as your stop loss and the high as your entry, this would barely be a 1:1 trade. Okay, but if you actually use the 50%, you can see how it increases your risk to reward by almost 1%. And then let's say you was able to refine your order blocks, and then you get a really wonderful entry just like this and take profit to the previous high. You can see how this dramatically increases your potential risk to reward on the trade. So like I said, I'll make a video that teaches you how to basically refine order blocks and deal with multiple points of interest. This is just to give you an overview. It's more like a beginner's basic guide to trading order blocks. Okay, so for a beginner, just like I would actually literally place my limit close to the highs of the candle, and then my stop loss would be below the candle, because I don't want to see price trade below the lowest point of the order block. So I expect the mitigations to take place between the high and the low of the candle. Okay, so whichever one you may likely use, but if you use the 50%, the problem may be that you may miss a lot of trades. Just like I said, sometimes price doesn't even come to the highs. Okay, you have examples where price just comes really close and then we see a reversal. But the downside with that would be a larger stop loss placement, and you can choose to utilize the 50%, but that would mean that you might miss a lot of trades. Okay, so you basically choose whichever one. For take profits, it is basically the high before the retracement. Okay, so just like we have impulse, retracement, impulse. For example, let's say the retracement starts at around this previous high. That is basically where you want to target. You want to target previous highs, because this is where we're looking to offload our orders. Okay, because we know that they're pending buy orders and whatever the case may be, and stop losses above previous highs. So we're looking to sell our buy orders to those who are looking to buy from us. So let's look at some practical example on the charts on how to take entries on these order blocks. So as you can clearly see right here, now this is a wonderful example. Okay, we have price clearly trending to the upside, we have impulse, retracement, impulse, and in this case you would have taken a loss on this because price didn't necessarily decide to obey this order block. But then since we have a break of structure to the downside, this is actually the last up candle before the down move. Okay, so you can, let me zoom in nicely so that you see what I'm talking about. So this is the last up candle before this down move, and if you placed, now this all boils down to what I was saying. Okay, so let's do this practically so that you don't take my word from it. So this is your last bullish candle before this down move, and if you actually use your FIB to take the 50% of it, you would see that price got to exactly the 50%, or it didn't really get to the 50% of the candle. Let me zoom in once more, and you would see that we never really traded to the 50% of the candle. So if you actually took your entry at the open of this candle, you probably would have gotten a larger stop loss, but you would have been triggered into the trade compared to someone who would actually be waiting for the 50%. So basically you can take your entry on the lowest or the highest point of the candle, the open of the candle, and the 50%. So those are areas you may likely look to take your entries, and you can see that we had a mitigation that was picture perfect. Okay, so we had another break of structure, and it's okay for you to take sales. And as you can see, this is our last bullish candle before the down move, and you can see that we had a mitigation there, we had a reaction, but order flow is now bullish, because if you actually look at this, the trend was strongly trending to the upside. So you probably would have gotten out break even or whatever the case may be. And then you can see we have this impulse exhaustion, this impulse break of structure. Okay, this is a valid point of interest, but this is a likely more valid point of interest because this is where the whole move began. Okay, I'll talk about this more in the video where I talk about refining order blocks. So you would say this is your last down candle before the up move, possibly, but as you can see that and when it comes to order blocks, you don't want to take on candles that have too many wicks on both sides. You're looking for large candles like this because the momentum actually signifies how and when smart money traps traders. Like you can see here, we had a strong bearish candle, and the next candle almost engulfed this one. So these are areas you want to see something like this. So if you took this as your point of interest, you were not wrong. And as you can see, price, let's take the whole range to be our point of interest. And I think price came to the 50%, but always don't forget to factor in the spreads. Okay, you don't want to place your limit exactly on the open or the close, and it might differ. What you have on TradingView might be different from what you have on your broker, so you want to take that into consideration. And then you can see there was a mitigation, and just like I said, entry stop loss below the candle. If you use this as your last down candle, this will be your stop loss, but for me, I would likely take it to be below here, and the previous high is your target. Okay, so as you can see, beautiful 1:3 on this one, and beautiful 1:3 without you even having to refine to the lower time frame. Okay, so imagine what the entry and stop placement would be like if you refine. This would have been like a 1:20 or so. Sorry about that, I have a cold. And as you can see, impulse, correction, impulse, correction, impulse. So this is actually where the break of structure all started from. So it's okay for you to take this as a point of interest, and as you can see, bang into the level and price with an impulse. So I hope you got some clarity from this. And as for your assignment, you're basically going to take 20 screenshots of bullish order blocks and 20 screenshots of bearish order blocks. Now, you can send these screenshots on me on Telegram or on Instagram. The link to my handles will be in the description. The reason for the assignment is to make sure that you actually understand everything that I explained to you. So I'm expecting your screenshots, and let's get some likes on this video. If we get enough likes on this video, I would seriously release another video that shows you how to refine order blocks and a complete order block strategy. So I hope you got some clarity on this one, and don't forget to boop the subscribe button, get some more likes on the video. It's important, you know, it helps the channel push the video. Don't forget to stay legendary, guys. I will see you in the next video. Peace.